Hello and welcome! My tax accountant is thrilled to bring you this guide on a topic that marks a huge moment in anyone's life, paying off your mortgage. It's a time for celebration, absolutely. But could there be a little surprise waiting for you from the tax man? Let's break down everything you need to know for the 2025/26 tax year so you can make sure that party is not spoiled by any unexpected bills.
So let's just dive right in, shall we? You've been paying this thing off for years, maybe even decades. You're on the home stretch, about to make that final payment and own your home free and clear. But then this nagging little thought pops into your head. Is HMRC about to swoop in and take a slice of the celebration? It's a massive worry for a lot of people. And you know what? It's a really smart question to ask.
And I've got fantastic news for you, right from the get-go. For the vast majority of us who own our main home here in the UK, the answer is a big, simple no. Paying off your mortgage has absolutely zero tax implications. No hidden charges, no extra forms to fill out. You can take a massive sigh of relief.
Okay, so here's a quick look at what we're going to cover. First, we'll nail down that simple, good news answer for your own home. Then, we're going to wade into some of the trickier waters, like what happens when you gift money to family, the completely different world of being a landlord, and some tips for business owners. And to finish off, we'll look at some really smart ways to use all that extra cash you'll have and pull it all together into a clear plan.
Right then, Section 1. The simple answer. Let's really understand why paying off the mortgage on the house you live in is so wonderfully straightforward when it comes to tax. This bit is the foundation for everything else, so let's get it locked in.
So here's the logic, and it's actually pretty simple. All those years you were paying mortgage interest, you never got a tax break for it on your main home. It wasn't a deductible expense. So because HMRC never gave you any relief on the way in, they have absolutely no interest when you stop paying it on the way out. It doesn't change your income tax one bit. Plus, if you ever decide to sell, any profit you make is almost always completely free from capital gains tax, thanks to something called private residence relief. So like Priya in our example, your tax situation stays exactly the same.
And here's a quick pro tip. While the tax man isn't a concern here, your bank might be. If you're planning to pay off your mortgage before your current deal, say a 5-year fix, is up, you really need to check for early repayment charges, or ERCs. These are lender fees, not taxes, but wow, they can be steep. We're talking 1 to 5% of what you still owe. On a £100,000 balance, that could be a £5,000 fee you weren't expecting, so always check the small print. Okay, let's switch gears. What if you're in the incredibly generous position of helping someone else out, like one of your kids, to pay off their mortgage? Well, that's a wonderful thing to do, but this is exactly where you can accidentally wander into a bit of a tax trap, and this one's called inheritance tax.
So, every single person in the UK gets what's called an annual gift exemption. For the 2025/26 tax year, it's £3,000. You can give away this much money every year to whoever you want, and it will never ever be a problem for inheritance tax. It's your tax-free gift allowance.
But let's be realistic, helping someone with a mortgage is probably going to cost a lot more than $3,000. Any amount you give over your annual allowance has a special name. It's a potentially exempt transfer, or PET. The key word there is potentially. When you make the gift, a 7-year clock starts ticking. If you, the person who gave the money, live for a full 7 years after making that gift, then great. It becomes completely exempt from tax.
But what if you don't make it the full 7 years? Well, that's where this sliding scale or taper relief kicks in. If the person giving the gift passes away in the first 3 years, that gift gets hit with the full 40% inheritance tax rate. But as you can see, the longer they live, the lower the potential tax bill gets. It drops to 32%, then 24%, and so on, all the way down to 0 once you cross that 7-year line. It's a crucial rule to understand if you're planning on gifting a large sum.
All right, let's talk to the landlords out there. Because for you, paying off a mortgage on a buy-to-let property is, well, it's a whole different kettle of fish. For a rental business, that mortgage is a key financial lever, and getting rid of it has some really significant tax implications you need to be ready for.
You see, the landscape for landlords has changed so much. In the good old days, before April 2020, you could deduct every single penny of your mortgage interest from your rental income. It was fantastic for reducing your taxable profit. But now, that's all gone. Instead, you get a tax credit, which is basically a 20% reduction on your final tax bill based on your interest payments. It's way less generous, especially for higher rate taxpayers.
So, here's the kicker. The moment you pay off that buy-to-let mortgage, your interest payments drop to 0, right? Well, that 20% tax credit was tied directly to those interest payments. No interest means no credit. It just vanishes.
So think about it. Your rental income is exactly the same, but a tax relief you were relying on has just disappeared. The result? Your final tax bill goes up. It's a real sting in the tail.
But hang on. There is a very powerful and totally legitimate strategy that landlords who also have a mortgage on their own home should know about. And it's not some sneaky loophole, it's detailed right there in HMRC's own rulebook in a section called BIM 45700 of the Business Income Manual. So how does this work? It's pretty clever. The rules say that you can raise finance on your business, your buy-to-let portfolio, to pay yourself back for funds you've previously put in. So you can take out a new loan against your rental property and use that money for pretty much anything, including paying off the mortgage on your own home. And here's the magic part. Because that new loan is secured against the business asset, the interest you pay on it now qualifies for that 20% tax credit. You've essentially swapped your bad personal debt for good business debt. Now, this is definitely complex stuff, and it's absolutely crucial you get professional advice before even thinking about it. Okay, moving on. Let's create a little playbook for all the self-employed people, the freelancers, the small business owners who are running their empire from a home office. What happens for you when that mortgage disappears?
For sole traders, I've got more good news. It's super simple, just like it is for any other homeowner. You can carry on claiming for a portion of your household running costs, things like electricity, gas, council tax, based on how much of your home you use for business. Since you could never claim for your mortgage interest in the first place, paying the mortgage off makes zero difference to these calculations. Nothing changes.
All right, now for the really exciting part. You've done it. You have paid off the single biggest debt you will probably ever have. And suddenly, every single month, there's a big chunk of extra cash sitting in your bank account. The big question is, what's the smartest, most tax-efficient thing to do with it now? This is a classic dilemma people face. Should I use my spare cash to clear the mortgage faster, or should I invest it instead? This table breaks it down nicely. Overpaying feels amazing, right? It saves you interest and gets you to that debt-free day sooner. But that cash is then tied up in your house. On the other hand, putting that money into an ISA means it can grow and grow, completely sheltered from tax. If your investments can earn more than your mortgage interest rate, you could actually end up financially better off by investing.
Here's a little did you know moment for you. Let's say you've been saving up a big pot of cash in a regular savings account, ready to pay off the final lump sum of your mortgage. Well, that cash is earning interest and you might be paying tax on it without realizing. Basic rate taxpayers get the first £1,000 of interest tax-free, but it's only $500 if you're a higher rate taxpayer. By using that money to pay off the mortgage, you stop earning that interest and you could wipe out an unnecessary tax bill in the process.
And this chart really shows you the powerful tools you've got in your arsenal now. That money that used to go to the mortgage company can now be put to work. You've got a £20,000 ISA allowance for tax-free growth, a massive £60,000 annual pension allowance, which also comes with tax relief from the government, and you've got a capital gains allowance too. Using these wisely is the key to turning your old mortgage payment into future wealth.
So we have covered a lot of ground. Homeowners, landlords, business owners, gifting. How on earth do you pull all these different threads together into a simple, clear plan that works for you as you start this exciting new chapter of your life? Let's just boil it all down to the absolute essentials, the key takeaways. Number 1, for your main home, it's simple and tax-free. Relax. Number 2, if you're gifting money, that 7-year inheritance tax rule is everything. Be aware of it. Number 3, for landlords. Remember, clearing that BTL mortgage means losing your tax credit, so your tax bill is probably going to go up. 4, for business owners, there are some smart plays you can make. And finally, for absolutely everyone, the game now is to reinvest that extra cash as wisely as you can, using your pension and ISA allowances to their absolute max.
Look, becoming mortgage-free is a massive, massive achievement, and you should be incredibly proud. But as we've seen, the tax details really do matter, and they change depending on your personal situation. A one-size-fits-all plan just isn't going to cut it. The smartest next step is to get advice that's tailored specifically to you. The team at My Tax Accountant live and breathe this stuff. You can get in touch with them easily, give them a call or a WhatsApp on 07854 255 375, or just drop an email to info@mytaxaccountant.co.uk. I really hope you found this guide useful, and for more just like it, please do make sure you subscribe to the channel. Thanks for joining me.